Okay, so here we are. This is Chapter 5, second lecture. Chapter 5 is on money and banking. And I've got today's Wall Street. This is very timely, and this is an example of why I do talk to you about current events, especially news from the Wall Street Journal, because the things that we are doing here are very timely. So here are the headlines of today's Wall Street Journal. Fed. Now, if you didn't take this course, you may not even know what the Fed means, right? So you might be lost right away with the first word. But Fed, of course, means Federal Reserve. And that's exactly what we're talking about in Chapter 5, right? Money and the Federal Reserve. So Fed, back pace of rate hikes. Rate hikes meaning interest rates. And I'll just read to you a little bit about, in the first sentence, paragraph, Federal Reserve officials dimmed their view of the economy and said they likely won't raise interest rates. Now, won't raise interest rates. How does the Federal Reserve raise or lower interest rates? Well, that's something that we're going to talk about today. This is very timely. Won't raise interest rates as swiftly as they had previously anticipated. A nod to lingering risks posed by soft global growth and financial market volatility. So anyway, we are going to talk about this today, and I do have a short video for you on money and banking. And if I can get to it, let me see. And this is about 7 minutes.
Discover where money is created. The process works like this. Suppose Congress needs more money than it has. I know that's a stretch. Perhaps it's done something really historically foolish like cutting taxes while conducting 2 wars at the same time. Now, Congress doesn't actually have any money, so the request for additional spending gets passed over to the Treasury Department. You may be surprised, or dismayed, or perhaps neither, to learn that the Treasury Department lives hand to mouth and rarely has more than a couple weeks of cash on hand, if that. So the Treasury Department, in order to raise cash, will print up a stack of Treasury bonds, which are the means by which the U.S. government borrows money. A bond has a face value, which is the amount it will be sold for, and it has a stated rate of interest that it will pay to the holder. So if you bought a bond with $100 face value and that paid a rate of interest of 5%, then you'd pay $100 for this bond, and you'd get $105 back in a year. Treasury bonds are sold regularly in auctions, and it's safe to say that the majority of these bonds are bought by big banks, such as those of China and Japan recently. At auction, the banks purchase these bonds, and then money gets sent into the Treasury coffers, where it can be dispersed for the usual array of government programs. Now, I promised you that I'd show you how money first comes into being, and so far that hasn't happened, has it? The bonds are being bought with money that already exists in the banking system. Money is created by this next mechanism, where the Federal Reserve buys a Treasury bond from a bank. When the Fed does this, they simply transfer money and the amount of the bond to the other bank and take possession of the bond. A bond is swapped for money. Now, where did this money come from? Glad you asked. It comes out of thin air as the Fed creates money when it buys this debt. New Fed money is always exchanged for debt, and so now we can put the title on this page. All dollars are loaned into existence. You don't believe me? Here's a quote from a Federal Reserve publication entitled Putting It Simply. When you or I write a check, there must be sufficient funds in our account to cover the check. But when the Federal Reserve writes a check, there is no bank deposit on which that check is drawn. When the Federal Reserve writes a check, it is creating money. Wow. Now that is an extraordinary power. Whereas you or I need to work to obtain money and place it at risk to have it grow, the Federal Reserve simply prints up as much as it wishes whenever it wants, and then loans it to us all via the U.S. government, with interest. Given the fact that over 3,800 paper currencies and a few metallic ones have been rendered worthless due to mismanagement, wouldn't it make sense to keep a very close eye on whether or not the Federal Reserve is acting responsibly? So now we know that there are 2 kinds of money out there. The first is bank credit, which is money that is loaned into existence, as we saw here. Bank credit is a type of money that comes with an equal and offsetting amount of debt associated with it, debt upon which interest must be paid. And the second type of money is printed out of thin air, and that's what you see right here at this stage. The process by which money is created is so simple that the mind is repelled. So don't worry if you need to review this chapter several more times. However, if you understood all that and get it, well, congratulations, give yourself a hand, because it's not easy. These monetary learnings allow us to formulate two more extremely important key concepts. The first is that all dollars are backed by debt. At the local bank level, all new money is loaned into existence. At the Federal Reserve level, money is simply manufactured out of thin air and then exchanged for interest-paying government debt. In both cases, the money is backed by debt, debt that pays interest. From this key concept, we can formulate a truly profound statement, which is that, at a minimum, each year, enough new money must be loaned into existence to cover the interest payments on all of the past outstanding debt. If we flip this slightly, we can say that each year, all the outstanding debt must compound by at least the rate of interest on that debt. Each and every year, it must grow by some percentage. Because our debt-based money system is growing by some percentage continually, it is an exponential system by its very design. A corollary of this is that the amount of debt in the system will always exceed the amount of money in the system. I'm not going to cast judgment on this and say that it's good or bad. It simply is what it is. By understanding its design, though, you will be better equipped to understand that the potential range of future outcomes for our economy are not limitless, but rather bounded by the rules of the system, all of which leads us to the fourth key concept, which is that perpetual expansion is a requirement of modern banking. In fact, we can make a rule. Each year, new credit or loans must be made that at least equal the amount of all the outstanding interest payments that year. Without a continuous expansion of the money supply, past debts would not be able to be serviced and defaults would ripple through and possibly destroy the system. Defaults are the Achilles heel of a debt-based money system, which we saw in our local banking example in the previous chapter. Because of this, all the institutional and political forces in our society are geared towards avoiding this outcome. So the banking system must continually expand, not necessarily because it's the right or wrong thing to do, but rather simply because that is how it was designed. It's a feature of the system, just like using gasoline is a feature of my car's engine. I might wish and hope that my car would run on straw, but I'd be wasting my time because that's just not how it was designed. By understanding the requirement for continual expansion, we will be in a better position to make informed decisions about what's likely to transpire and take meaningful actions to enhance our prospects. So the key question is this: what happens when a human-contrived money system that must expand by its very design runs headlong into the physical limits of a spherical planet? One more belief of mine is that I will witness this collision in my adult lifetime, and in fact it may have already started, and I am extremely interested to see how this is all going to turn out. Now, this is admittedly a truly gigantic proposition to consider, and some would say that it's not very interesting at all, or rather it's just frightening. Well, if you want the future to look exactly like the past, then I suppose it is frightening. But if you are flexible in your view of the future, then you have an opportunity to make the most of whatever future actually arrives. These are fascinating, invigorating, and truly unprecedented times, and I am thrilled to be living right here, right now, with you. In the next section, we'll be looking at some very important historical context about our money system.
So anyway, that's all I'm going to show you. Yeah. Bye-bye. Let's see. So any questions about that? So the point here is that the Federal Reserve is a separate entity from the U.S. Treasury. The U.S. Treasury is part of government. The Federal Reserve is not. And another thing you've got to know is that the U.S. Treasury does not bring money into existence. the purpose of the U.S. Treasury is to pay the bills for the federal government and to collect, to help in the collection process. But in terms of money alone, the creation of money, that lies in the hands of the Federal Reserve, which was originated in 1913. The Federal Reserve became law. By the way, 1913 was the first year that income tax was instituted in the United States. This is all under President Woodrow Wilson. So what we're going to talk about today is exactly how does the Federal Reserve monitor the nation's money supply? How does it increase or decrease the money supply, and what effect does that have on interest rates? And exactly how can the Federal Reserve influence interest rates? Now, in all of this discussion, I'm going to try to refrain from using the word control, because the Federal Reserve doesn't control interest rates, but it can greatly influence interest rates. That's an important distinction. So what is the Federal Reserve System? The Federal Reserve is a central bank and monetary authority of the United States, also known as the Fed. So the Fed, that abbreviation, never means the federal government. It always means the Federal Reserve. And the function of the Fed to ensure the availability of enough money, just as that short video we watched, he talked about, to ensure the availability of enough money and credit in the banking system to support a growing economy. All right. Yeah. And as I already mentioned, the Fed was established in 1913. And what does the Fed lend money to private companies? Now, before 2008, the Fed would only buy government bonds, and it doesn't have to create money, by the way, to buy those bonds. It can use existing money that it has on hand. But when it does create money to buy bonds, that's what we call quantitative easing. Now, the term that we used to use is monetizing the debt, but now we use the term quantitative easing. That's when the Federal Reserve actually creates money to buy bonds. And how's the Federal Reserve create money? Well, the federal government uses the Federal Reserve as its bank. Just as you might have a bank, the federal government has a bank. So when the federal government uses the Federal Reserve as its bank, then when the federal government sells bonds to the Federal Reserve, what normally happens, if not all the time, is the Federal Reserve simply has to credit the government's account, because the Federal Reserve is the federal government's bank. So it buys bonds, government bonds, and it simply pushes a few keys on the computer and credits the government's account by X billions of dollars. And then the government can write checks against that. And that's how new money is created. Now, before 2008, the Federal Reserve would buy bonds only from the federal government. But since 2008, the Federal Reserve is buying other financial assets, and very often with newly created money. So quantitative easing is when the Federal Reserve creates money, buys federal government bonds, or buys bonds from some bank or other entity. So why would the Fed want to decrease the money supply? To lower inflation. Now, we've got two basic problems, at least when you're talking about the Federal Reserve. We have inflation and we have unemployment. So traditionally, now we don't live in traditional times. We live in very well, things are happening today that have never happened before, but I'm going to talk about this as it normally would be. But if we have inflation, the Fed would want to decrease the money supply. Because if we can decrease the money supply, then people will spend less, demand goes down, and prices come down. And if we have unemployment, then the Fed would want to increase the money supply. We increase the money supply, people spend more because now we have more money in the system, demand goes up, and employment goes up. And how many Federal Reserve banks are there? The United States is divided into 12 Federal Reserve districts, and each district has a Federal Reserve bank. Like the closest Federal Reserve bank to us is in Richmond, Virginia.
Do you think the Federal Reserve would have issues with like new currency like bitcoins?
Well, yeah. Virtual currencies like Bitcoin is a competitor to the Federal Reserve and to our money system. Yeah, it's a competitor. That could, at some point, that could be a problem.
I just noticed my bank they said, hey, here's a new account you can open up, but it's a Bitcoin account.
A Bitcoin
A
account?
Bitcoin account.
No
They
kidding.
said you can purchase, it was like $500 for one Bitcoin. I said, well, what can I buy with one Bitcoin? I have no
Wow.
idea.
What bank is that?
USA.
USAA?
Yeah, I took this political survey, and and one question was like, are you like for Bitcoin? And I had no idea what it was, so I had to like look it up.
Huh. Well, I've talked about it before, right? Haven't I?
Yeah.
Yeah. Maybe you missed that lecture.
Yeah, I did.
But yeah, Bitcoin is a virtual currency. It's one of many. There's a virtual currency that comes out of Floyd, Virginia. That's becoming, more and more popular, but it's not nearly as big as Bitcoin.
What's
But
the name of that?
I don't know. But there's some fella in Floyd that started a virtual currency, and anyone can start a virtual currency. Yeah.
How do you get Bitcoin? Like, are you paid in Bitcoin? Like as a salary?
Well, you mean is your question how does Bitcoin come into existence?
Yeah.
Well, now that is the key question, because why is Bitcoin perhaps a better alternative to the American dollar? And the answer is that the American dollar can come into existence willy-nilly. That there's no limit of how much the banking authorities can increase dollars. But Bitcoin and other virtual currencies can only come into existence through a prescribed set of circumstances. That there's a limit to how much can be brought into existence. Now, the original bitcoins are brought into existence by these very complex mathematical puzzles, and people. It used to be individuals, but now they work in teams. But people who can solve these puzzles, it's a contest. And people who can solve these mathematical puzzles are rewarded with X amount of Bitcoin. And that's how Bitcoin comes into existence. But only so many can come into existence at any one point in time. And by 2030, no more will come into existence. So that is why, the American dollar can lose its value because the more we increase the money supply, the value of each unit goes down. It's like anything else. If something becomes more plentiful, easier to come by, less scarce, then the value of each unit goes down. And if you're talking about money, the volume of money in existence, then with the value of each unit going down, when you and I go to the store to buy something, it takes more units to add up to the value of whatever it is we're buying, because the value of each one is much lower. And that's the danger, you see, of a currency that can come into existence without limit. But Bitcoin is more stable. Bitcoin is stable only because by its very existence, it is more stable, because only a certain amount is going to come into existence in a certain period of time. And that's why virtual currencies may become the standard currency. I mean, government currencies may become extinct because they'll inflate out of existence. That makes sense? Also, the other advantage with Bitcoin is that it's international. It's not dependent upon any government. See, the U.S. dollar ultimately depends on the success of the American government and the American economy ultimately, but Bitcoin doesn't depend on any country because it's international. So that's another big advantage of these virtual currencies. Yeah, that's good. I'm glad you brought that up, because this is a good time to talk about virtual currencies. Okay, so who makes decisions for the Federal Reserve? The Board of Governors and the Open Market Committee. I'm going to talk about these two committees briefly, but the Board of Governors, they're appointed by the President and serve 14-year terms. There are 7 Board of Governors. They serve 14 years. The terms are staggered so that someone's term will expire every 2 years, and they cannot be redesignated after that 14 years. Now, you might think, well, the President appoints, and so and the U.S. Senate approves. That's just the way our federal system works. With appointments like this, the President will appoint someone, but then that appointment has to be approved by the U.S. Senate. So you're thinking, well, then the federal government must have a lot of clout when it comes to the Federal Reserve, because it's the President who appoints and the Senate who approves these appointments. But that's not exactly true. And it's not exactly true because the President can only appoint people onto the Federal Reserve, onto the Board of Governors, from a list that is provided to him by the Federal Reserve. So the Federal Reserve ultimately, you see, controls who sits on the board. And now the Board of Governors, these 7 people, are the central decision-making authority of the Federal Reserve. You know, do we increase the money supply or decrease it? If we want to increase it, by how much? If we want to decrease it, by how much? Well, it's the Board of Governors that makes those decisions. Now, there is a chairman of the Federal Reserve, and this is a little different than the other members. The chairman is appointed by the President every 4 years, and then he has to be redesignated for another 4 years. Now, a chairman can serve for multiple years. There's no end to how long the chairman can serve, as long as who's ever president says, yeah, I like this person and I want to continue working with this person. Now, the way that's organized is that the chairman of the Federal Reserve's term expires 1 year prior to the presidential election. So when we get a new president, he's going to work with the chairman for 3 years, and then after 3 years he says, well, I've liked working with this person and I want to redesignate this person. Or he says, I've had a hard time working with this person for the past 3 years and I want to appoint someone new. Okay, now that's assuming, of course, that people don't retire. Now, how many Board of Governors serve for 14 years? Well, not very many. I mean, people retire and things happen, and same with the chairman. But if people didn't retire, then this is the way it would work. See, now the Federal Open Market Committee is made up of 7 board members and 5 presidents of the Federal Reserve Bank. Now, there's 12 Federal Reserve banks. Each bank has a president, and 5 of those presidents serve on the Open Market Committee on a 1-year rotating basis. So the president of the Federal Reserve of Richmond will serve for a year and help make open market decisions, which I'll explain to you what that is in a minute. They help make open market decisions, and then after a year, they'll go back to be full-time president of the Bank of Richmond. Now, the way it works is it's not a full-time job. Like, take the president of the Federal Reserve Bank of Richmond. He may go to Washington, D.C. for maybe, I don't know, it depends how active things are, but maybe a couple days out of the month, maybe 3 or 4 days. I don't know what it is, but he's most of the time he does his duties as being president of the Federal Reserve Bank, but he will take some trips to Washington, D.C., and he'll sit in on some important meetings, and he'll give his input and then help make decisions. Now, the decisions that he helps make are open market decisions. Now, we're going to get into the different monetary tools, the different ways that the Federal Reserve can influence the money supply, but the most common way is to buy and sell government securities. And so, let me see where the next slides take me. Okay, well, maybe I better follow these slides. What is the role of the Federal Open Market Committee? Makes decisions as to buying and selling of government securities. Okay, now this takes some explanation. Maybe I'll explain it now. All right. The Federal Reserve buys government security. A security from the federal government is the federal government's way of borrowing money, right? And there's lots of people and lots of organizations that can buy government securities or bonds. And one of the purchasers of these bonds is the Federal Reserve. Now, a place where bonds, not only government bonds, but all bonds can be bought and sold is called the open market. See, we buy stock from an exchange like the New York Stock Exchange. It's a market. It's a physical place where people who want to buy stock go, and where people who have stock to sell go, and so it's a market where they meet. Well, the open market is a market where bonds are bought and sold. If you own a bond and you want to sell it, you can go to the open market. If you have if you want to buy a bond, you can go to the open market. See, the open market is a physical place. It's a market where bonds are bought and sold. Now, the federal government sells bonds. Corporations sell bonds. That's a method of borrowing money. And a bond is simply an IOU. It's on a piece of paper. It's written, how much is lent out, what interest is going to be paid, how that money is going to be paid back, when it's going to be paid back. It's the agreement between a borrower and a lender, and the piece of paper, that legal agreement, is what is called a bond. Okay? Now, you got to understand that, let's say that you buy a bond from the federal government or from anybody, let's say from a corporation, and that bond is going to be, it matures, let's say, 10 years. Now, what that means is you buy a bond for less than the face value. Like if you buy a government bond, if you buy, let's say, a $10,000 government bond, you'll pay less than $10,000. And then on the date that's on the bond, you can take that bond into the issuer and receive the face value. So bonds are bought for less money than the face value, and they're worth the face value on a certain date that is on the bond. Does that make sense? Now, let's say you buy a bond, either from the federal government or from anybody, and the bond matures at some date in the future. The face value is $10,000. And let's say 10 years, it matures in 10 years. But let's say 3 years goes, you buy the bond. 3 years goes by and you say, I don't want to hold this bond for another 7 years. I want cash. I want to get out of it what I can. So you're going to sell your bond. Now someone is going to buy it from you for something less than $10,000, right? They wouldn't pay you $10,000 because then they got to wait for another 7 years and get back exactly what they paid for it. So they're gonna pay you something. Now, you've got a bond for sale. You take it to the open market. How much is someone going to pay you for that bond? Well, it's a market. It depends on what the market will bear. What's the bond worth? The bond's worth whatever someone's willing to pay you for it. It's like if you own a house and no matter what the city says it's appraised for, how much is it worth? It's worth what someone is willing to pay you for it, right? And same with the bond. What's a bond worth? Well, before it matures. Now, when it matures, it's worth its face value. But how much is a bond worth before it matures? Well, that depends on how much someone's willing to pay you for it. Period. See, this is a market. So same. Now we'll get back to the Federal Reserve. The Federal Reserve has government securities. They don't have government securities necessarily to make money, although that is true that they do. You make return on these securities, but they use these securities as an economic or monetary tool to monitor the nation's money supply. Now, I'm getting ahead of myself here, but I gotta explain to you what the Open Market Committee is. But it'll all come together as I go through this lecture. But anyway, the Federal Reserve has government securities. Banks have government securities as part of their game plan, as part of their portfolio. And so if the Federal Reserve wants to increase the money supply, the Federal Reserve can go to member banks. Let's say I'm the Federal Reserve and you're member banks. I've got government securities. You've got government securities. Now, y'all get the picture? I want to increase the money supply. All right? So I come to you and I'm going to buy securities from you. Now, how am I going to convince you to sell me some of your securities? Well, I'm going to give you an offer you can't refuse. See, I'm going to give you a good price, and you say, wow, that's a great price for these securities. I'll sell you these securities for that price. So, you give me your securities, I give you cash. Now what's happened is that your excess reserves increase. Now, all banks are required to keep a certain amount of their money in what is called required reserves. This is money that's used to meet day-to-day transactions. And they lend money out from their excess reserves, which is money above and beyond the required reserve. All right? So when I buy bonds from you, then your excess reserves, which is cash, increases, which increases your liquidity. Now, if you can lend this money out, then we've increased the money supply. See, when I buy securities from you, your banks, I'm the Federal Reserve. When I buy securities from you, have we increased the money supply? No, because it's not in circulation. It's just sitting in banks. In order to increase the money supply, in order for that money to do any good, you've got to lend that money out. So again, let's say that we have unemployment. I'm the Federal Reserve. I'm concerned about unemployment. So the Open Market Committee, which is 5 board governors and 7 presidents, no, the other way around, 7 board governors and 5 presidents of Federal Reserve banks, those 12 people, they say, we've got an unemployment problem. We want to increase the money supply. So we're going to buy X amount of securities from banks. So we buy these securities from you. You become more liquid. Say, you weren't very liquid when you had bonds. I mean, you were somewhat liquid, but cash is more liquid than bonds. So I'm going to buy these bonds. See, because you can't lend out bonds, but you can lend out cash. That's why cash is more liquid. So I'm going to buy these bonds from you. Your excess reserves go up. You become more liquid. And if you can succeed in lending this money out, then demand increases and jobs are generated. And that was our whole purpose. Now, if we have inflation, the opposite is true. If we have inflation, if I'm the Federal Reserve and you're member banks, not just member banks, but all banks, I want you to lend out less money. So in this case, I will come to you and I will sell you securities. See, I use securities not necessarily, the Federal Reserve, well, officially, the Federal Reserve doesn't exist just to make money. Officially, the Federal Reserve exists to monitor the nation's money supply. I say officially. That may not be true unofficially. But anyway, I won't get into that just yet. But anyway, if we've got inflation, see, I've got securities, you got securities. I sell you securities. Now, what's going to convince you to buy my securities? Well, I'm going to sell you at a low price. See, a low price because the securities mature at a certain future date, and whatever the face value is. So the less you pay for it, the greater return there is for you. So I'm going to buy your securities. I'm going to sell you my securities, and I'm going to charge you a low price, so you'll be encouraged to buy them. Now you've got more securities, less cash, your excess reserves go down, you're less liquid, you lend out less money, demand goes down, and prices come down. Now that's how the Federal Reserve uses federal securities as a monetary tool to monitor or to influence the nation's money supply. Now notice here I'm not using the word control because the Federal Reserve doesn't control the money supply, but it can influence it by several different ways, and this is one way that the main way that the Federal Reserve can influence the money supply. Either it attempts to increase it or attempts to decrease it. Now that's a big explanation just to know what the Open Market Committee is. But that's part of our money supply. I mean, that's how our monetary system works. And I'm not going to get into member banks. What do the letters FDIC stand for? Federal Deposit Insurance Corporation. Well, that's something different. I just had to put it somewhere. But the Congress has brought an insurance into this whole system. See, our whole banking system relies on confidence. If people lose confidence in the banking system, then they're not going to participate. I mean, when you get a paycheck, let's say you get $1,000 paycheck, and you bring it to your bank and you give it to your bank. Well, that takes a lot of faith. I mean, you've got to have a lot of confidence in your bank that they're going to keep track of it. You're going to be able to write checks against it, or you're going to be, they'll put it in a savings account. It takes a lot of confidence. Now, if you lose confidence, if you say, well, I'm not sure about this banking situation, well, you might be reluctant to put your money in the bank, right? So what helps makes it so that people have more confidence in banks? Well, that's where the FDIC comes in. The FDIC is a corporation that was started by the government, by Congress, and what it does is that it insures each account up to X number of dollars, like $200,000, so that if you've got money in a bank, and you could have several accounts, different separate accounts of your own and your spouses or your children, whatever. And then you could do that with several other banks. But each of those accounts is insured so that if something happens to the bank, then money is taken out of the FDIC to give you. So you're not going to lose your money. So the FDIC is insurance that banks pay this insurance. All banks pay into this insurance, and then if a bank goes bankrupt and there's no money there to make good on people's accounts, then money's taken from this insurance to make good, and that is to give people confidence in the banking system.
Are there incentives for jobs to pretty much just say, okay, we're gonna go ahead and only do direct deposit, so then that way they force people to get bank accounts?
Oh, bank accounts? I don't know. It's been a long time since I got paid, with a check. I would assume in today's day and age that in the majority of cases your paycheck is directly deposited, and like you say, if that's the case, then people have to have a bank account. So I don't know how to exactly answer your question. I think I'm safe to say that to have a bank account in today's world is a whole lot more important than it was maybe 20, 25 years ago.
I still want to put my money in my mattress, though.
Yeah, well, you can have a bank account and still put your money in the mattress. You can take it out of the bank. But that's a good question. And the FDIC was established in 1933. Okay, part of Franklin Roosevelt's New Deal programs during the Great Depression. Was the function of the FDIC insure deposits in any bank institution that purchases FDIC insurance, which is 99.9% of banks. How much are deposits insured for? $250,000. I don't know. This changes from time to time. I think this is the latest figure, but I'm not sure. Not important. What is the name of the market where money is bought and sold? The loanable funds market. Now, when you go to the bank to borrow money, then you're participating in what's called the loanable funds market. See, it's a market. You want to borrow, someone wants to lend. You've got a buyer and a seller. That's a market. What's the name of that market? The loanable funds market. It's a market where money is bought and sold, essentially. Just definitions. Why would the Fed want to expand the money supply if we have unemployment? And I've explained this, and contract it if we have inflation. Now, I'm kind of running out of time, so I'm getting ahead of myself. The Federal Reserve is more powerful when it comes to fighting inflation than it is unemployment. And the reason is that the Fed cannot force people, or banks cannot force people to borrow money. In other words, if we have unemployment, then I'm as the Federal Reserve, I might buy bonds from you. Your excess reserves go up. You become more, as a result, you become more liquid. But if you don't lend that money out, the money supply is not increased. And the point is that you can't force people to borrow money. People have got to voluntarily come to the bank and borrow money. So if we have an unemployment problem, then the Federal Reserve is not very effective, because when we have unemployment, people tend to be pessimistic. They're unemployed. A lot of them are unemployed or underemployed. And if we make it easier for them to borrow money, well, that's no guarantee they will borrow more money. I mean, an unemployed person isn't going to run the bank and borrow money to buy a car just because interest rates are lower. See what I mean? See, that's one thing. If we have unemployment and I sell you more bonds, you become more liquid, how are you going to lend that money out? You might lower interest rates. But there's still no guarantee that people are going to come to the bank and borrow that money. So the Federal Reserve is not very good at stimulating the economy when we have unemployment. But the opposite is true when we have inflation. Now, if we have an inflation problem and the Fed puts the brakes on, the Fed may sell government securities to you being banks, in this example, then you have less money to lend out. And there's a good possibility that people therefore borrow less, and demand goes down and prices come down. So the Federal Reserve has much more of an influence when it comes to inflation than it does unemployment. Okay. Now, unfortunately, we've relied more and more on monetary policies. And less on fiscal policies. Monetary policies are policies of the Federal Reserve. Fiscal policies are policies of the federal government. And because the federal government has not chosen to make hard decisions to correct economic imbalances using fiscal policy. Now we're going to talk. We've got a whole chapter just on this, so I'm not going to go into this in detail. But let me just say that we have several tools in our toolbox, both monetary with the Federal Reserve and fiscally with the federal government. But we have, for one reason or another, we haven't used a lot of these tools, especially the fiscal tools of the federal government. So we have, over the years, we have relied more and more on monetary policies, but the Federal Reserve is not very good. The monetary policies are ineffective when it comes to fighting unemployment. So really, in terms of our monetary and fiscal policies, we are left with very little. That's really my main point. Now, because we're running out of time, I just got to say this about monetary policies. There are basically 4 different types of monetary policies. The buying and selling of government securities is one monetary tool. Another monetary tool is to raise or lower the discount rate. Now, the discount rate is the interest rate that banks pay when they borrow money from the Federal Reserve. That's called the discount rate. So when we have unemployment, the Fed may lower the discount rate so that it makes it easier for banks to borrow money. In theory, they'll borrow more money. In theory, they'll lend out more money. Demand goes up and jobs are generated. If we have inflation, the Fed could raise the discount rate. Banks, therefore, will borrow less money from the Federal Reserve. They lend out less money, consequently. Demand goes down and prices come down. Now, this is very simplistic and very narrow in scope in terms of the explanation. But anyway, the other monetary policy is reserve requirements. Now, it's discount rate and the federal funds rate. The federal funds rate is the interest rate that banks pay to borrow money from one another. Usually these are short-term, 24-hour, 48-hour type bank loans. And the interest that one bank pays another to borrow money is called the federal funds rate, and the federal funds rate is determined by the Federal Reserve. Now, the only two interest rates, there's only two interest rates that the Federal Reserve actually controls. That's the discount rate and the federal funds rate. All other interest rates are determined by market forces. However, the Federal Reserve can influence those market forces. All right, now there's a lot in that statement. The only two interest rates that the Federal Reserve actually controls is the federal funds rate and the discount rate. All other interest rates are determined by market forces of supply and demand. But the Federal Reserve can influence, not control, but influence those market forces. All right? Okay, now the Fed can also raise or lower the reserve requirement. Now, all banks are required to keep a certain amount of money in reserve to meet day-to-day transactions. So if we have unemployment, the Federal Reserve could lower the reserve requirement. Instantly, banks will become more liquid, their excess reserves increase, and they can lend out more money. If we have inflation, the Fed can raise reserve requirements, excess reserves decrease, banks have less liquidity, they lend out less money, demand goes down, and prices come down. But the changed reserve requirement will not happen unless the situation is very dire, because when the Federal Reserve changes reserve requirements, they're changing the rules of the game, and that brings a certain amount of instability into the banking system. See, let's say again you're a bank and you have a game plan, a business plan. You have a portfolio of you'll lend so much money out for this purpose and so much money for that purpose, and you'll keep so much in this account and so much in that account, and you've got a game plan. Well, part of your game plan, your business plan, is the reserve requirement. I mean, out of all the money that is at your disposal, how much of it can you not lend out? How much of it do you have to keep on hand to meet day-to-day transactions? That's determined by the Federal Reserve. All right. Well, when the Federal Reserve comes along and changes the reserve requirement, especially if they were to raise it, then all your careful planning goes out the window, and this brings about a certain amount of instability into the banking system. So even though raising and lowering the Federal Reserve requirement is a monetary tool, it is not used hardly at all. Now, the other three are used, but of the other three, the one that's used most often is the buying and selling of government securities. All right, the Federal Reserve makes decisions on certainly a weekly basis of buying and selling, how much to buy or sell of government securities. Now, they will change the discount rate if things are serious, and the federal funds rate and the discount rate they will change, but only if we've got a serious situation. So 95% of the time, if you're talking about monetary policies of the Federal Reserve, you're talking about the buying and selling of government securities. All right. Well, we've about run out of time, but that really explains the Federal Reserve in a nutshell. So what are y'all gonna do for next time? Read chapter 6, right? So I'll see you all next time.
And watch the videos too, right?
And
watch the videos.
Well, that helps. Yeah, I don't require the video.